Welcome to Yahoo Finance Live. We've been watching the chairman of the Federal Reserve, Chairman Jay Powell, address the most recent statement from the FOMC. I'm Adam Shapiro along with Shauna Smith, and there's quite a bit that we've gotten in the last hour and a half. So let's first take a look at where markets are because we're off the session lows. There's a lot of reaction to this dot plot, which indicates that several members of the FOMC expect at least one rate increase in 2022, and several expect at least two by 2023. So we saw the Dow, the S&P 500, the Nasdaq fall from that, but we also saw the 10-year Treasury. It's up about the yield is up about 10 basis points off this morning's low. It was around 1.48. It has skyrocketed up. And it is something that we're paying attention to because we heard Jay Powell say things such as, quote, the dots are not a great forecaster of future moves. Dots should be taken with a big grain of salt. We're going to have a whole lot to talk about after he said that. Shauna?
Yeah, Adam, I think that's the one thing that investors were really focused on here because we saw the initial reaction when the Dow was off right around its lows of the day of 382. And then once he said that the dot plot wasn't the best indicator of future moves, we almost saw investors breathe a little bit of a sigh of relief. And I also, what stood out to me was some of his commentary about the labor market, the positive tone that he took with the labor market and really saying that he expects a strong bounce back to happen over the next couple of months and into the fall. But we want to get to our Fed reporter, Brian Cheung, who was just able to ask the Fed chair a question not too long ago. Brian, just give us your big takeaways from the press conference and from the statement that we got from the Fed.
Yeah, well, I think we all have to just take a big step back and just breathe for a second because this was a more eventful meeting than I personally had anticipated. Now, obviously, the expectation was that at some point the Federal Reserve was going to signal that it was kicking off those discussions about tapering its $120 billion a month pace of asset purchases. But a lot of bond managers, fund managers were saying that might not be until August or September. But it seems like the economic recovery is progressing at fast enough of a pace that the Federal Reserve was able to talk about tapering in this particular meeting. Now, of course, the Fed holding interest rates steady at near zero and making no immediate changes to its balance sheet program. So it seems like on the surface, nothing changed really all that much, but we're getting a lot more clarity as to what the next steps for the Fed might be. And the first step would be, first of all, retiring the term of talking about tapering. That's what Chairman Powell just said in that press conference. And that's because they already had those first initial discussions in that meeting today. Now, of course, whether or not the Federal Reserve is going to tee up the actual tapering itself at some point remains an open question. The Fed chairman, for his part, telling reporters just now that the Fed is beginning to have conversations about what it's looking for before it starts to assess that the economy has made the substantial further progress towards being at a place where the economy can then sustain a pace of asset purchases that's lower than the $120 billion that it's doing now. So very much a premature conversation, but that conversation has indeed started. Now, as far as the dot plots, you see them ahead of you right now. This is extremely notable because when you compare them to the March dot plots, it shows that the median member of the 18-member committee now sees 2 rate hikes by the end of 2023. This was a surprise because if you rewind just 3 months ago, the same 18 members were projecting at a median level, at least, that the interest rates would be at near zero through that time horizon. So obviously something over the last 6 weeks convinced a number of policymakers to upwardly revise where they could see the economy going. And that's likely because of the higher expectations for economic growth. When you look at GDP, for example, the FOMC median now seeing 7% GDP growth in 2021. That's a notch up from where we saw those projections in March earlier this year. So all in all, it seems like the Federal Reserve giving us more clues as to the balance sheet tapering, as to even interest rate policies, although the Fed chairman saying, don't get too rattled. These are just projections. Hold it with a big grain of salt, as you mentioned, Adam, but of course, setting up a very interesting next few weeks as the Federal Reserve heads into the next policy meeting and then eventually the Jackson Hole meeting, which will be at the end of August, which could make for some very interesting conversation.
Brian, I know you're going to be at Jackson Hole, and a lot of people are now going to be making the decisions based on what we anticipate to be said at that meeting.